The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. The fixed income market is facing a period of unprecedented change. Rising interest rates, persistent inflation, and market volatility are reshaping the way investors approach bonds and other income-generating instruments. So what does this mean for portfolio strategies? Which sectors or instruments present the best opportunities, and how can flexible, unconstrained approaches help investors navigate uncertainty? How should retail and private banking clients position themselves in this evolving environment? Well, to find out more, joining me now is Julien Houdain, who is the head of Global Unconstrained Fixed Income at Schroders. Hi, Julien. Welcome to the show.
Hi everyone. Thank you very much for having me on the show.
Thank you so much for joining us. Well, Julien, to start off, can you give us a little snapshot of the current fixed income market? How are interest rates and inflation shaping investor expectations here?
So there's a lot at stake at the moment in the fixed income market, and I would say there's two parts of the fixed income market. There's the rate sensitivity, which would be very dependent on what you said in your question, basically the inflation, the growth, the impact of the different policies from central banks. And on the other end, there's the credit risk, what you're getting paid for default risk, basically, when you invest in corporates, in securities, and some part of the sovereign market. So we see two different patterns on that side. One market, which is the rates market, is telling us that central banks are more accommodative, short-term rates are relatively well supported, which is good for risky assets. But within this same market, we see a lot of pressure on the long end, basically part of the curve, so long end rates, 10, 30-year parts, which are getting a bit out of control for central banks. And the market players are asking a higher and higher yield, basically, to invest and support government spending and fiscal spending all across the world. So all governments are competing to find lenders in that part of their credit curve. And same then for the equities, the part that is the premium for credit default is relatively tight historically. So when you buy credit, you're not very well compensated at the moment for the potential of a kind of hard landing, recession fears that could arise if we continue to see a deterioration of the data basically in the US. So to answer your question completely, we see support from central banks. We know the Fed is ready to cut rates if data continue to disappoint, which is good for risky assets. They feel supported by the central banks. And fiscal stimulus continue to be ample across the world, which again support basically risky assets. So you end up with a relatively high valuation in equities market and relatively tight spread in the credit markets in fixed income.
So what would you say are the most significant trends in fixed income that investors should watch right now?
So the best trend in fixed income is basically in the name. It's income. Income is great in the sense that you can lock in very nice yield in the fixed income markets for a very low amount of risk. So we see some asset classes within the investment grade space, which is historically very safe, both from a default risk perspective, but as well from a volatility perspective. And you can generate very close to 6%, for example, yield with a very defensive portfolio. You will have to hunt probably in the US agency MBS part of the market. You will have to hunt in some specific countries in Europe where you find a discount for certain corporates there. So you need expertise as well to generate this yield. But you can build a very defensive portfolio, and we see clients very interested in that part of offering, for example. So that's, for me, the main trend in fixed income. And alongside that trend, you've got a trend that is a lot more about risk management, and you have to be careful that at the moment, a lot of positive news are priced in fixed income markets. And you have to be relatively careful about potential risk of either a kind of hard landing scenario, so much weaker growth, which will put a spread much higher. So you have to be careful about that. And as well, the risk that we see higher inflation, like we saw in 2023, 2024, where the US economy surprised on the upside the markets. And this scenario can happen probably not into year end, but early next year. So you want to be careful as well with your rate sensitivity in the portfolio. But you're getting very well paid at the moment in the fixed income space.
But I mean, what risks are most concerning then for both institutional and retail investors in this environment?
So if I look at the set of discussions I have at the moment with clients, they're concerned about tight credit spreads. So they think they are not very well compensated for the potential increase in volatility. And that I can understand that. Historically, we have the tights in terms of credit premium, both in the US and in Europe. But that's worse if you look at the overall market, the overall index. There's always some companies that offer some value that the market don't know very well. Or US players, US-centric players, for example, they won't play much. European companies, which always tend to trade as a discount. So you still can find value there, and you can find basically shelter in case of higher volatility. And companies that would benefit from German stimulus, for example. But yes, overall valuations are expensive, and people are concerned that if we see a weaker environment, lower growth, especially coming from the US, credit spreads will move wider, and basically the returns may be negative. So that's I think, the main concern for investors. And obviously, there's the concern what I was mentioning about the 10-year and 30-year part of the government curve. But I think investors have left a bit that part. They find yields are attractive from an historical basis. I feel they would like to invest, but I can't find any arguments basically to convince them. And in all strategies will really be focusing on the 1 to 5 year part of the fixed income curve basically, and really stay away, if not shorting the long end, the long maturity bonds.
I mean, with rising rates and market volatility, investors are increasingly looking beyond, traditional bonds for more flexible fixed income solutions. So can you explain what unconstrained fixed income strategies are and why they are gaining attention at the moment?
Yeah, well, I think Unconstrained has been very interesting, especially since 2022. I mean, prior to that, fixed income was very much about your credit risk. The rate risk was very subdued because there was a lot of intervention from central banks. And as well, inflation has been muted since the great financial crisis across the world. So fixed income was sort of very easy asset to manage. Since 2022, and obviously inflationary pressure, it's a totally different game managing fixed income. And you need to be much more nimble on where you invest and in which part of the curve, for example, but also which part of the world, because we see different dynamics. Central banks are not in the same cycle across the world. You see that at the moment. For example, Japan is hiking rates. Europe has been cutting rates. The US will probably cut rates relatively soon. There's very different patterns in terms of policies. And for this, you need to be nimble. You need to be unconstrained to extract value for investors. You can't be concentrated in one part of the market anymore. And you can't really buy, benchmark approach. A benchmark approach is very much about buying many bonds across the same market. Today, if you buy a benchmark in global credit or passive investment in global credit, you will buy a lot of long-dated bonds, 10, 30 years, which, might underperform on a total return basis because of this pressure on the long end of fixed income. So by Unconstrained, you want really to focus on the best part of the fixed income market over the cycle. And the best part of the market at the moment might not be the best part of the market in 2 years' time, for example. So you want manager, but as well strategy that can, in a flexible manner, adjust through the cycle. And that's what we do offer with our Unconstrained strategies.
Okay, so how can flexibility in duration or credit selection or even asset allocation help investors navigate volatility?
Well, because you want to be in the part where there's still a bit of value, and when you think volatility is gonna be lower. So basically, it's very simple. You want to maximize your information ratio, so the highest returns for the lowest volatility. If you think at the moment, that's why we are very interested in the short end of the fixed income market, especially the treasury market. I think that's where we will see the less volatility because it's well supported by the Fed. It's well supported by the president, which wants to see rates staying relatively low, if not lower, in the US. And you want to avoid part of the market where you see high level of uncertainty and volatility, which again will be the 10 and 30-year part of the curve. So that's an example that you want to find refuge in a part of the market where volatility is going to be relatively subdued. The same for credit risk. You don't want to be invested in all companies. Some companies are going to be very expensive as of today. And you want to be invested in companies that still offer some value, so potential for spread compression and total return for investors, but as well companies that will be handling basically potential volatility in markets, either from an inflationary perspective or from a recessionary perspective. That's what we do, and we find a lot more value, for example, in Europe at the moment on that side from a stock picking perspective.
Are there any examples of how these strategies have performed in the past periods of market stress?
Yeah, I think they've performed very well because obviously you can pinpoint where you're going to take your rate risk rather than to have a kind of a passive sensitivity to rates. So we have been very nimble there. Some of our peers are nimble as well, but obviously you add value compared to passive or to more entrenched strategy with a big bias toward a certain region or a certain style. Here we combine really very a different set of alpha generating pillars and try to remove as much as possible the bias towards a certain style, a certain asset class, a certain region, so you can really maneuver the volatility when it's there. And also you want to be ready for potential periods of volatility, so risk management is very important. At the moment we have very low amount of risk in our strategy. We have the lowest amount of credit risk over the last 5 years because, as we were saying, valuations are expensive. We were in the same position earlier in the year, so we were very well positioned for the volatility around Liberation Day, and we've been buying a fair amount of risk during that period. And that's the whole purpose about Unconstrained. You want to have a strong risk management. You want to be in the right part of the market, so when there's volatility, actually you're not in panic mode, but you're on the offensive, and you can buy basically interesting part of the market at the cheap basically and generate performance for the coming months for clients.
So how are investors currently approaching fixed income at the moment? Are they more cautious or still seeking yield?
Well, they're seeking yield. We can see that, and they're interested. And I would say the strategies like income strategies where you've got a fixed payout are very much in favor, especially in Asia. So we see a lot of success there. So they're very interested by again, looking some very nice yield, which even compare, if you earn a payout of 6.5% to 8%, even compared to a higher level of inflation on a real term, it is very attractive. So you're really protected even for higher inflation from here. Real rates will stay significantly positive. So it's a very nice proposition for investors. And then it's more depending on the manager they pick. Some managers will be very concentrated in certain parts of the market. Like the US manager tends to be very concentrated toward the US and the securitized market. I think we tend to be much more diversified, and I can see clients, they do like that. Clients are coming back as well to the European markets. They find interest there in that market. They're a bit more careful with the US concentration. So we've got product and we've got obviously the capabilities at Schroders and the resource to access the European markets. We are market leaders there from a performance perspective and size perspective. So that's a kind of a blend we can bring as well to the strategy. So I think investors are interested in the payout and basically of how this payout is formed, and they want to see more diversification nowadays.
Well, given the evolving interest rate and inflation landscape, Julien, what should investors be preparing for over the next few months?
So investors should be careful about the potential for weaker environment in the next 3 to 4 months, let's say into year end, where we could see a soft patch in the US economy, knowing that the rest of the world is not doing too well, and that could trigger really a recession kind of fears. This is not priced in the market, either spreads or the equity market. So we need to be careful for that. And you will make the link with what I said earlier, that we are running the lowest amount of risk in the portfolio over the last 5 years. So we're well positioned for that if it happens. On the other end, then, especially the US economy can muddle through the next 3 to 4 months. And actually all the noise around tariff haven't broken anything in the US economy. So we continue this soft landing scenario. Early next year, you've got a lot of positive for the market. You have the tax cut in the US that are kicking in, so it's fiscal support. You've got the German stimulus in Europe that is to start to accelerate. So again, it's more money into the economy. So with this kind of fiscal support, both in Europe and especially in the US with the tax cuts, we could see a growth picking up, morale and picking up, sentiment picking up. We start to see investment picking up from corporates as well. And this will happen in a very tight job market. There's less and less workers in the US, and that can put pressure on wages and that can put pressure on inflation. I mean, we saw this movie a few times over the last 2-3 years, where the US economy is surprising the market, and this is not priced in the market at the moment. The market is expecting inflation to be a bit higher into year-end because of the tariff effect, but we can be in a scenario somewhere next year with all this fiscal support coming to the economy, and that inflation is actually much higher than what is priced at the moment. And that's where you need to be careful with fixed income portfolio, and that can create volatility across risky assets as well. So we stay relatively low in the amount of duration risk that we take in the portfolio. And again, we favor very much the short end of the US curve at the moment.
Some great insights from you there. Thank you so much, Julien, for your time and your insights today.
Thank you very much. Thank you very much for your time.
Thank you. That was Julien Houdain, who's the head of Global Unconstrained Fixed Income at Schroders. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.